So we're in this moment right now, and we've been in this moment for a little while, where we're back to higher interest rates on, let's say, the 2-year, the 10-year, negative for a certain type of stock. Big stocks, important stocks. But then when those rate fears ease for the day, it's like a green light to go out and buy them. It's very reminiscent, Judge, and you'll probably remember this, of the risk-on, risk-off stuff from 2011, 2012, when on a Monday it would look like Europe is Armageddon, and then the next day European currencies would rally, and there would be this like whole group of stocks you could just blindfold yourself and buy any of them. We're doing that now with interest rates, and it's fun. It's interesting. Eventually, everyone learns the game and it stops working. But look at today. You get the rate fears cool off a little bit. What are your top 3 leadership groups? Surprise to surprise. Real estate number 1, up 1% on the day. Consumer discretionary number 2, up almost 1%. Number 3 is industrials. Number 4 is tech. It's like surprise, surprise. So today
Russell.
So here's what I want to do. I want to coin the term. We're going to call it cut on, cut off. Today is a cut-on day, right? You got a little bit of easing in rates. People are a little bit more sanguine about, what's happening with the inflation story, and they'll let these stocks run. If you get something that seems to be negative on the inflation front, or tomorrow's jobs report is a blowout number, or average hourly earnings are way ahead of schedule, you're going to see it be a cut-off market. And you're going to see industrials down big. They'll crush the real estate names. They'll hit consumer discretion. So this is the new game. I hope you all learn it. I hope we can have this game for, I don't know, as many weeks as we have until June, July, and then eventually it'll end. But that's what's happening right now. And you could track it yourself on your screen.
The biggest risk you see is the possibility that we do have reigniting inflation more stickier than people think, and then the Fed's got to either act on that or just keep rates much higher for much longer than even people suggest.
That is the risk, and I think if you listen to what the Fed had to say the last time they had the presser, they were basically like, look, a strong labor market alone in and of itself is not going to interfere with us doing what we think we need to do on the interest rate side. I don't think the market believes them, quite frankly. So I would be looking to tomorrow, and don't worry about headline. So we're looking for 216,000 jobs. Don't worry so much about that, because if that's at 300,000, no one's going to fall out of a window. Look at average hourly earnings. Look at hours worked. Like, look at the stuff that's really going to filter into PCE in the near term. That's the stuff where the market really might not like it. To Liz's point, she's exactly right. And I remain of the thinking earnings are not the risk. It's just it just isn't. International stuff is not the risk. This is the risk that the Fed says, you know what? One more wouldn't kill anyone. And we're back to talking about when is the next 25 basis point hike. I don't think we're there yet. I just think if you want to worry about something, that's the thing you should worry about.
Have your mind on energy, and you're looking at some stocks specifically that you think are looking pretty interesting these days.
I do. Thanks, Scott. Last week, as my final trade on Thursday, I wanted to highlight IEO, which is the Explorers and Producers ETF. It tends to own the more high beta energy names. Everything I'm about to tell you also applies to the larger names. The entire group is going higher, in my opinion. I think this could be a leadership group when we look back in December, just based on the strength that I'm seeing here. And I want to take you to trade school for 2 seconds. You'll hear this term tossed around a lot on this network and others, overbought. And a lot of people don't even understand that there's a statistical definition to overbought. And what they further don't understand is overbought is not necessarily negative. So the connotation when someone says, oh, that stock's up too much, it's overbought. Ask yourself the second question, though. Why is it overbought? Is there maybe a fundamental reason why everyone is accumulating this stock? There might be. Maybe it's overbought because the stock is going to keep going and go higher. So you have overbought names in the energy patch right now. And I submit to you, that's not a reason not to be in them. Maybe you don't buy them right this second. But here's what I want you to consider. You have the average RSI, that's relative strength, at about 78 in the XLE, which is the energy ETF, the largest cap names. This is the highest reading of all time for the RSI in the XLE. We have data going back to 2004. So in 2 decades, we haven't seen this much buying pressure in these names. And I'm telling you right now, to me, that doesn't feel like the top. That feels like a reintroduction to this space for people who haven't looked at it in a couple of years. Now, You look at crude at 85, the highest level since October. It's up 17% year to date. Then you think about how underweight most managers are to the E&P names, and you get excited. So here are some charts that look exceptional. Carrie, I'm going to come to you in a minute. ConocoPhillips, this is the largest component in the IEO ETF that I just mentioned. It's about 18% of the weighting. This thing is on fire. Marathon, MPC. Take a look at Diamondback, FANG, cute name. The other one is Phillips 66, which is, of course, a refiner. These stocks are all overbought. That's short term. In the longer term, there's a reason this much money is piling into these stocks, and I urge you, if they're not on your ticker, put them on your ticker, keep an eye on them, because I think there are some really exciting things developing.
Was the best in March.
Yep.
And your overall suggestion is that it could keep going.
The four names that I just mentioned, here's what's fascinating. Yes, the stocks are up a lot, but you're not overpaying necessarily for these names. The median trailing 12-month PE ratio for those four is 11 times. The median price to free cash flow is 13. You've got 7% expected earnings per share growth over the next year. So these are not like horrifically overpriced, monstrous semiconductor stocks. That's not what's going on here. These are under-owned, underrated names that people haven't paid attention to really until the last month or so. So I think that's really important. The second thing I would say, and this is a market-wide thing that I want you to understand, we keep a list of the best stocks in the market. And some of the things that we're using for inclusion, we're looking at relative strength. We're also, of course, looking for profitable companies. We're looking for companies that are within spitting distance of new 52-week highs. The most stocks in my list right now, if you look at the 11 sectors, are coming from the energy space. I got 13 of them from energy out of a list of 68. So there's something happening here that people should just keep in mind. Now, when do you buy them? Well, here's the thing with overbought stocks. RSI's at 78, probably not like the all-time greatest entry. So you're looking for low volume pullbacks in these names to start a position. In my experience, you will get them. On a day like today and yesterday, it feels like, oh, it's never going to pull back. It left without me. I get it. I understand that feeling. I have been through that before. You'll get it. Wait for those low volume pullbacks. Wait for the downgrades on valuation or whatever nonsense. That's when you want to get excited.